Hello everyone. Good morning, good afternoon, good evening, depending upon when you're watching this video lecture. After the first two chapters in the economics of finance, which dealt with the determination of national income and public finance, let's move on to the third chapter that is related to money market, in which there are three units, and we'll start with unit 1 in the current session. This chapter 3 is all about the money and how money plays a crucial role in any economy, and how the demand for money and supply for money can be determined or assessed, and most importantly, what is the monetary policy that is taken by central bank of any country, particularly referring to Indian context of Reserve Bank of India. That will be in unit 3 of chapter 3. But prior to that monetary policy, we need to understand broadly two aspects and concepts of money. One is demand, which we discuss in unit 1. Another one is supply of money, which we will discuss in unit 2. Then unit 3 will cover the monetary policy related concepts. So this unit 1 of chapter 3 is about the concept of money demand, and it will consist of various aspects to be understood, like what are the functions of money, what is money and what are the characteristics and functions of money, and what is this demand for money, what is it and why is it there in any country or economy, and then various theories related to the demand for money. There are many types of theories. So this is mostly, entire unit 1 is a theoretical perspective of demand for money as envisaged by famous economists in almost a century's time. Of course, these theories were again classified into three subcategories. One is called as classical approach, other one is called neoclassical approach, and then the most famous Keynes theory of liquidity preference for money. So that is called LPT, liquidity preference theory, as proposed by Keynes. Once again, one of the most famous economists, particularly from macroeconomic aspects. We cannot ignore Keynes theories, be it in public finance, be it in national income determination. You would have observed Keynes' contribution to the macroeconomic principles is tremendous, and that continues even in the perspective of money also. So his theory is very famous, called as liquidity preference theory. These are but still little old theories, before Second World War, we can say. Then post-Keynesian theories are also there, after the theories developed by classical and neoclassical economists. After Keynes, some more economists have proposed or postulated different theories. So those are generally can be categorized as post-Keynesian developments in the theory of demand for money. But ultimately, this unit is all about the theories which are related to demand for money. So we are looking at this aspect of money in an economy, that is demand aspect. Demand for what? Demand for not commodities, demand for not goods, not for services, not for anything else. Demand for money. So for that purpose of understanding demand for money theories, first of all we should understand what is money. If anybody is asked that question, they will say, I know that. Everybody knows what is money. What is a big deal in that? But just knowing what is money or feeling that I know about money is not going to exactly characterize money in technical terms. So what is money? We have to define it, understand it, and apply it technically from the economics point of view than from our normal layman's language or normal understanding of money is money. We have money, we use it for spending. Yes, that's true. But is it the only thing? No, it has many other characteristics also and shades also. So we need to look at the money from economics perspective, how money can be defined or how money can be understood. In that perspective, let us look at that. In simple terms, money refers to the assets which are commonly used and accepted. Accepted is very important. As means of payment or as a medium of exchange or of transferring the purchasing power. So, three words are used. Here, one is it is used as a means of payment, not just used. It is used and accepted as a means of payment or as a medium of exchange or of transferring the purchase power. So, whatever asset which is commonly used and accepted for these purposes can be called as money. Let us say in the olden days, maybe in the Raja Maharaja's days, there would be some coins, maybe gold coins, silver coins, like that. That was money then because it was accepted then. Now, as far as normal understanding is concerned, most of the world is using currency notes which are accepted by other people as means of payment and as a medium of exchange and transferring the purchasing power. So, in the current scenario where we live in, this can be treated as money, which is paper money. Actually, it will not have any intrinsic value. That paper is of no use if it is not accepted. As such, paper has no value. But on that paper, something is printed, some number is printed, that is the denomination of that particular paper, what we call as currency note. And most importantly, that paper is accepted by the others. Then only it is money. For example, if I write on a white paper that this is 10,000 rupees worth paper and I will sign on that, maybe I will put my seal on that, just because of my signature and seal, will that paper really become 10,000 rupees worth? It will not, because my signature, my seal has no value. Then who has to sign? Definitely the central bank of the country has to sign. In India, the Reserve Bank governor will sign that paper. Once he signs that paper, that becomes currency, then that becomes money. Otherwise, that piece of paper has no value. And it will be guaranteed by the government. It is guaranteed by the government. Naturally, in India, only central government has the authority to guarantee the money that is promised by RBI to be paid to us in the form of these currency notes. So we'll look at this Reserve Bank of India's role and what is this currency and how it will be supplied from the RBI in the next unit, where we will understand the supply aspects of money. But since we are looking at the demand side of money in this particular unit, let us stick to that part. But in order to understand what is money, we need to definitely understand, yes, currency is also a money as long as it is accepted. Now this example can easily be understood for us. Prior to 2016, such a situation could not be dreamed also. But now we know that the 500 rupees and 1000 rupees old notes were stopped to become legal tender from 9th of November onwards in 2016. So what happened then? Government said these notes are not acceptable anymore. That means they ceased to be money from that day onwards. Of course, they could be converted into other new notes, which most of the people did. But the point is, after that announcement, technically, they have stopped to be legal tender. So what is that legal tender? That is one of the major characteristics of this money in a currency format. We have to also understand something. Currency is definitely money, but money is not equal to currency. Money is more than currency. But we take currency as an example because we can see that, we can actually feel that, that is tangible in front of us. So easy to understand. But that does not mean money means currency only. No. Money refers to assets which are commonly used and accepted as means of payment. Any asset it could be, whatever it could be. So that is money. Of course, for understanding purposes, since we have seen the currency notes and coins in front of us with eyes and we feel that it is money, there is nothing wrong in calling them as money. That is money, definitely, yes. The currency that we are talking about, cash, is money. It is money. But it is not only money. Money does not mean only currency or cash. It is more than that. That we will see later. But at this point, we just have to understand the basic definition of money, which is nothing but it is an asset which is commonly used and accepted as a means of payment or as a medium of exchange or of transferring the purchase power. So if one person has 100 rupees with him, he has the purchasing power of 100 rupees with him. He can purchase anything with that 100 rupees. But if he gives this 100 rupees to somebody else, what happened? The purchasing power is transferred from one person to another person. So now who has the purchasing power? The new guy who got this 100 rupees has the purchasing power. So money is that which transfers the purchasing power from one person to another person. So that is the basic definition of money, we can say. But for policy purposes, money can be defined as the set of liquid financial assets, the variation in the stock of which will have an impact on the aggregate economic activity. So again, stock of money, supply of money, we will see more of that in the next unit. But while understanding what is money itself, for policy purposes, what we can understand money as is that type of liquid financial asset. Money is always referred to liquid. Liquidity is a word that is used for more money being available for spending and for using it in day-to-day purposes. So, money represents such liquid financial assets, the variation in the stock of which will have an impact on the aggregate economic activity. Variation in the stock of money means what? You take any 2 points. If there is any variation in the stock of anything between these 2 points, that becomes a flow. So flow is nothing but the variation in the stock of something between 2 different dates or points of time. Let us say on 1st April 2019, there is some amount of money circulated in India, whatever it could be. Few lakhs of crores of money is there in circulation in India. On 31st of March 2020, what happened to that? What happened to that? Has it increased or decreased, or what happened to that? Once again, don't think only from currency point of view. Maybe in this year currency might not have been newly printed or circulated. Doesn't matter, but still money will increase. How? That is how the supply of money will be increased due to the economic activity that happened during this period. So the variation in the stock of money will be indicating the aggregate economic activity, and that will have an impact on the aggregate economic activity also. That is what is money at a very broader level for policy purposes, not from usage point of view, from the macroeconomic point of view, from the RBI's perspective or central bank's perspective. We can consider money to be such a liquid financial asset, the change in the stock of which might have some impact on the aggregate economic activity. That is another definition of money, we can say. Just to understand in a little bit more, what is money? Once again, is a liquid asset, and it can be used directly instantly, conveniently, and without any costs or restrictions to make payments. If you give money, once again in the form of cash, we are looking at as an example always for convenience purposes. If this cash 100 rupees is given to somebody else, how much worth of goods or services you will get? 100 rupees worth only. There is no cost attached to this 100 rupees. Money, currency does not have any cost. Online transactions have cost, though that is also money, but cash does not have any cost when it is used for the transactions. So that is why, though there are other forms of money, the best and highest liquid asset within the definition of money also is cash or currency, because it can be used directly, instantly, conveniently. Suddenly you want to make a payment. People will say nowadays, digital India, digital transactions, cashless transactions are good. Yes, definitely they are good. Nobody is saying that they are bad. But imagine suddenly your internet is not working. You wanted to pay something. Imagine if a phone itself battery is down, but you want to buy something. You cannot do that. That means there are problems of inconvenience, possibilities are there. If you have cash with you or currency with you, no problems, except that somebody will steal it. That is an exceptional situation. So that is the advantage, or we can say the nature of money, which is the most liquid asset, which can be used directly, instantly, and conveniently without any costs attached to that. That is one thing to be noted also. And another point also to be noted while understanding the concept of money is that it is only one among the many kinds of financial assets. Money is not the only financial asset that households, firms, governments, or economic units will hold. They will hold so many other types of financial assets also, like bonds, like shares, what we also call stocks, or any other types of financial assets they can hold, mutual funds, etc. Money is one among the many kind of financial assets which people, when we say people, who are people? Households, firms, governments, and any other economic units, all of them put together. Any individual, organization, government, all of them might hold money, of course, but in addition to money, they might be holding other financial assets also. So in the asset portfolios, when you look at the asset classes, various types of asset classes that people will hold, in these asset portfolios, only money is one type of asset, not the only type of asset. That is one more point to be noted. This point once again can be related to the problem in the thinking process of understanding black money in India. Assuming that black money is stored in the form of currency only, and if we cancel that currency, automatically black money also will be eradicated, was not a technically correct thought. Yes, it would have definitely eradicated if implemented properly. A bit of black money held in the form of cash, old notes I am talking, after demonetization. But unfortunately that also did not happen. Imagine if that happened also. Imagine, as promised by government then, or expected by government then, officially Government of India gave an affidavit in the Supreme Court that after demonetization 3 to 4 lakh crores of worth money is not going to be deposited in the banks. 3 to 4 lakh crores of rupees of money is not going to be deposited into banks, which could be black money probably. So because that money is not going to be deposited into the banks, to that extent at least we would have eradicated the black money in the form of currency. The government has told the Supreme Court through an affidavit officially. But unfortunately what happened finally? Some 20,000, 30,000 crores only was not deposited. Other than that, entire money was deposited. But imagine if this 3-4 lakhs crores was not deposited as expected by government. Imagining it was a success. Whatever expected has happened actually. Even then, that does not mean that black money is eradicated. Why? Because money or currency in that particular sense is not the only financial asset that people hold. So all these black money babus or black money people, if at all There are definitely such kind of people who have amassed huge amounts of black money. What was the expectation? What do you think? They will keep that in the form of cash only? No. They would have kept it in many different financial assets because their asset portfolio would be much greater. Though not very substantiated piece of evidence, but still there is an estimation that by one of the agencies, hardly 10 to 15% of the black money is actually in the form of currency. Means more than 80-85% of black money or illegal money is not in the form of currency, it is in other forms. It could be bonds, it could be stocks, it could be real estate, it could be gold, some other types of assets. So in any individual's or organization's asset portfolio, money is only a very small portion. That is reality. Even if we hit that portion very effectively also, that does not mean other portions are automatically affected badly. So that is another miscalculation, unfortunately, that happened during the demonetization. But still, in spite of that, expectation was that at least from the currency point of view, we could have actually created trouble to these black money babus. Unfortunately, that also could not happen later. But while announcing or implementing, nobody knows whether it will really be a successful thing or not, because it is unprecedented thing. You don't know when you are doing something almost for the first time, eradicating almost 86% of currency in circulation from the economy. That never happened in the history of mankind. Then naturally you don't know the results. We cannot estimate them with accuracy. Optimism will be there in the beginning. Unfortunately, the results proved to be otherwise. But that is one other part. But in spite of that, even it was a successful venture, still it could have affected only one portion of the asset portfolios of different people, not the entire asset portfolio. Why? Because money is only one among the many kinds of assets or financial assets which the people hold in their asset portfolio. So these are the basic concepts related to money that we should understand before we move on to what are the various functions of money, characteristics and demand for money type of theories. So what are the functions of money? This can be a question. It was asked also recently. 2 marks question, 4 points, half of mark each, 2 marks full. If you write it exactly the same way, better thing. So what are the functions of money? First of all, money acts like a medium of exchange to facilitate easy exchange of goods and services. It is a medium of exchange. Sir, what if money is not there? Earlier also there was exchange. When money was not there, there used to be barter system. Then also trade happened, people exchanged goods and services. But what is the problem with that? Problem with that is, just for understanding what is the need for money, then we can understand the functions of money and how revolutionary idea this money has been, so that the trade and commerce has prospered all these centuries in the history of human race. Let us say one particular person has mangoes with him, other person has bananas with him, only for general understanding purposes. Example, let us say mangoes person, he has mangoes, too many of them. Bananas person, because he has cultivated them, he has too many bananas with him. All bananas he cannot eat, all mangoes this person also cannot eat. So what they thought? They will exchange. They will exchange these two fruits. That's what they thought. So mangoes person will give some mangoes, whatever that number may be, to this person, and bananas farmer or person will give some bananas to the mango person. Exchange happens, no need of money there, no problem. That is barter system. But what is the problem here? Problem is, let us say this mango person doesn't want banana. He wants apple. Right? But as far as his reach is concerned, apple is somewhere very far from him. He cannot go there and buy apples by giving them mangoes. On the other side, they are not available here. And he doesn't want banana. He wants something else. Maybe he wants apples, oranges, whatever they are. but he doesn't want banana. But he has too many mangoes which he cannot eat also. What he will do with that? Same thing can happen with this guy also. He doesn't like mangoes anymore. He doesn't want mangoes, but he wants something else. How these people can exchange when one person doesn't want what the other person has? How the exchange is possible? Not possible. That is where money comes into picture. Now, because of money, availability and circulation and overall pervasiveness, spread of money, all these things, if they are there now, what happens is, this person can sell the mangoes for money and buy whatever he wants. He doesn't have to only buy bananas. Earlier he had to buy only whatever is there which is exchanged to him. Now he can sell the mangoes for money. He got money now in his hands. Oh, he can buy apples, oranges, rice, whatever he wants, he can buy. Same logic applies to banana person. He sells this for money and he uses that money for purchasing anything. So now what happened? The medium of exchange is not some other good or service, it is money. So definitely that facilitated people to have a common medium of exchange. That is a common medium of exchange for sure. No need to buy something which we don't want. No need. In the barter system, that was a limitation. You have to buy. Maybe you want it, you don't want it. If you want to sell something, you have to get something else what is available in front of you. So that was a limitation which has created hurdles for exploring and buying new things. With money, that hurdle is gone. So it has become a medium of exchange which facilitates easy exchanges of goods and services. That is the first function of money. And second thing is providing a common measure of value. Okay, it's a common medium of exchange, and not only that, it provides a common measure of value. Once again, measures of values could be multiple. Let us say this mango person sells dozen mangoes and he exchanges it for 2 kgs of rice, let us say. Here mangoes are measured in number, rice is measured in kgs. What is the common measure of value between them? No common measure. And that might definitely lead to inequalities and unfair transactions. So now with the introduction of money, common measure is rupees only. So these 12 mangoes, let us say, are sold, the dozen mangoes are sold for 100 rupees. And with that 100 rupees, he purchased 2 kgs of rice. But what is a common thing in between these two is 100 rupees. So that become a common measure of value. That is a common denominator of value. It is denoting common value, not in kgs, liters, numbers, quantities. They do not matter. Money matters now. So that is why being a common measure of value is one of the functions of money. And the third scenario or another function of money is that it is a unit or a standard of deferred payments. So deferred means postponed. Now, let us say banana guy wants to buy mangoes, but he doesn't have the bananas ripen yet. Mangoes are ripen already. He has to buy mangoes by giving bananas only, but bananas are not yet ready. Maybe they will get ready after 2 months. Mangoes are now ready. Can there be an exchange there without actually physically giving bananas and taking mangoes? Not possible earlier. Now what is possible is that these two people can enter into an agreement, verbal or written, that, boss, you give me some mangoes now, I will pay you later. I will pay you later. So there is no need to worry about paying physically with some other good or service which may or may not be available now. So this payment can be done in the form of money in future. So the deferred payments need not be in the form of other goods or services anymore. That can happen with money. That is how money serves as a unit or standard of deferred payments. Whatever that other things are, other persons are having, selling, doesn't matter. How they are earning their incomes doesn't matter. You pay money, get the goods or services. Done. You want to pay now? Yes, that is a cash transaction. Or you want to pay later? That is a credit transaction. Credit transactions have become more possible with the introduction and spread of money. prior to that, in the barter system, because both goods have to be tangible and seen immediately, credit was not easy. Credit was not possible, but even if it was possible or agreed to, it was not easy to be extended. Now it is easy because there is no tangible thing here. It is only something that both are agreeing to some number. That number could be whatever that expression in the form of money. So it has become a standard or unit of deferred payments like that. That is one of the functions of money. And not only that, money facilitates the storing of value, both as a temporary abode of purchasing power, of course, money gives purchasing power, and not only that, as a permanent store of value, as long as that is not demonetized and all, which is a rarity. But normally, yes, when you have money, you have the money. Let us say you have money, currency or bank, whatever it is. That is a permanent store of value, right? The point is the value may decline because of the time value of money. The value of the money may decline for sure, but it is storing value. 100 rupees note is there. It is always 100 rupees note. 100 rupees note is not going to become 50 rupees note after some time. But what 100 rupees can get you might change. Today you might get 2 kgs of rice with 100 rupees. Maybe after 2 years you will get only 1 kg of rice with 100 rupees. That might change. But 100 rupees is 100 rupees. That is the store of value, even on a permanent basis. If value will reduce, might reduce, it will because of time value of money. That is a different story. But still it is a store of value permanently. Anyway, temporarily it is a store of value because that gives you purchasing power. With money you can purchase anything. Whatever is purchasable, that can be definitely purchased with it. So it is acting like a store of value both for temporary purposes as well as permanent store of value also it is acting like. So these are the functions of money. Very important question. It is a medium of exchange. It is a common measure of value. It is a unit of deferred payments, and it is a store of value for both temporary purposes as well as permanent purposes also. These are the functions of money. Now for understanding characteristics of money, how ideally it should be. This is also a possible question. What are the characteristics of money? Features of money. Generally it should be acceptable. If it is not acceptable, simply it is not money. Let us understand that. It is a useless piece of paper or anything else. It is one very important point here is money should be acceptable. That is one of the most important characteristics of money. Usually it should be durable or long lasting. It should not be very soft that it will have less durability. Ideally it should be durable, and it should be recognizable easily. There should not be too much of effort to recognize it. That is one of the reasons why different currencies are printed with different colors, so that recognition is easier. In fact, even blind people can also recognize the currency because the denomination of currency is there on the currency notes, even in Braille also. So ideally speaking, yes, it should be recognizable easily. It should be difficult to counterfeit, but still there will be always people who do that. Counterfeit in the sense fake currency should not be able to be created with that. Sufficient security measures are supposed to be taken. These are the characteristics of money ideally we are looking at. And it should be relatively scarce. If you are able to see it everywhere on the road like waste papers, then that is not money. It should be scarce. Somebody should do something to earn it. So it is not something that is quite commonly available like oxygen, freely available like that. No. It should not be like that. If it is like that, then it will have no value. That is the point. Then the purchasing power will go down. That's what happened in the countries like Zimbabwe, where almost the inflation is too high. Those are called hyperinflationary economies, and value of money is as good as negligible. So that is a problem in not managing properly the supply of money. Again, we'll see that in the supply of money concept. But as the characteristic of money, one of the features of money, it should be relatively scarce. It should be easily transportable, and it should be portable. It should be. Normal currency fits in our normal wallet. We are not going to weight lift them. That much heavy things are not there. It is easily portable, easily transportable. And most importantly, it should have uniformity. Uniformity, not necessarily in color and all, but the uniformity should be there in value for all the things of same denomination. It is not there. Just imagine if it is like that ki 2000 rupees pink note has 2000 value, and if at all in future government comes out with let us say 2000 rupees green note, it will have 1900 value only. Like that, is it possible? No, it is not possible. Should not be. So there should be uniformity in that, and naturally that uniformity comes with numbers. 1 rupee, 5 rupees, 10 rupees, 20, whatever it is. Whatever the type of it is, note or currency or money it will have same value. All of them will have same value, uniformity. One will not be highly valued, another will not be less valued. So that is another feature of money. Ideally it should be like that. And most importantly, it should be divisible into smaller parts also in usable quantities or fractions without losing value. So if let us say 20 rupees note is divided into 10 rupees and 10 rupees, is it losing its value? 20 rupees you cannot tear it into two halves and call it 10 rupees notes. 20 rupees is exchanged for 10 rupees, 10 rupees. Nothing actually happened. No change in value happened. Just currency note has changed hands, that's all. Value of the person or the purchasing power of the 20 rupees note also and 2 10 rupees notes also is same. So that is how the money should be ideally divisible into smaller parts. How smaller is once again a changing thing from country to country. But it should be divisible into smaller parts, and it should be usable in the quantities or fractions without losing value. That is also important. These are the characteristics of money: acceptable, durable, recognizable, difficult to counterfeit, scarce, portable, uniform, and divisible. These are the characteristics of money. Very important question, possible to be asked in the examination. So functions of money is also crucial point. Characteristics of money is also one of the important questions we can say. Now let us enter into the core aspect of this unit, that is demand. What is this demand for money? First of all, the demand for money is a derived demand. That can be a question. Demand for money is a derived demand. Do you agree? Yes. We should write the answer. Yes. And we have to justify that. Yes will not give you marks. Demand for money is a derived demand and is a decision about how much of one's given stock of wealth. That is what you have to always keep in mind. Somebody, any person will have some stock of wealth, whatever that could be, which is a bigger word, wealth. In that, how much of that should be held in the form of money rather than as other assets will be decided by a person. That is what is called a demand for money. So it is about a decision of the people. People include everybody once again. The households and organizations in general, we can say. How much of the stock of wealth should be held in the form of money if it is decided, that will constitute the demand for money, and that is a derived demand. Why it is a derived demand? Why it is a derived demand? Because if somebody wants 1000 rupees, let us say, that does not mean he is willing to have this 500 rupee notes with him. Just like that, 2 500 rupee notes I want. Okay, you want for what? What is your demand for that? Why do you want that, first of all? You are very obsessed with this paper currency, or you want to look at this note daily and you want to feel good about it? No, that is not the demand for that money. Demand for that money is not about that piece of paper. It is actually a waste paper. Otherwise, it is not useful for anything. It has no intrinsic value at all. But still, why want it? Why everybody wants it? Because it is not the money they want. It is not the money actually. Why people are demanding money? Because they wish to have command over the real goods or services with the use of money. So they need money so that they can spend it somewhere. You want to go to a movie and have popcorn and all other things at the movie, then you need money. So when you say, I want 1000 rupees, I want 500 rupees, why do you want that? What do you do with that piece of paper? It is useless. Actually, it is not usable for tissue paper also, because currency will have more bacteria actually than anything else. So it is useless paper as such. But still you want it, everybody wants it. Because it is a derived demand. Derived from what? Derived from the wish of the people to have command over the real goods and services. You want to buy a book, you want to buy a calculator, you want to watch a movie, you want to buy a pair of shoes, whatever it is. That is the real demand actually, what we have in mind. For that purpose, we want money. That is why the demand for money is actually not demand for money, it is the demand for liquidity and demand to store the value. Okay, you may not really want to watch the movie now itself, but you want to have this 1,000 rupees with you so that at any point of time in future, if you want to or wish to go to movie, you don't have to worry, you have that money with you. That gives you confidence. That is the store of value. For that purpose, people demand money, either to spend now or to spend in future, but to spend only. If money is not there for spending, spending could be in the form of again capital expenditure or revenue expenditure, whatever it is, doesn't matter. You can just spend it out or you can invest in something else, doesn't matter. But ultimately it has to be going out. Money which is coming in to any person's pocket or bank account will go out, should go out. Then only it is money worth for an economy. A lot of times it so happens what? That is where the problem with black money is. Most of the times it is idle. It will not be actually spent out, is the perception of the government. Reality is different. It is not actually idle. It is spent in different ways, in the form of daughters' or sons' marriages, in the form of Diwali crackers, in the form of movies that we are seeing and being made, not now, earlier. Much of this money was used. And most importantly, the biggest usage of the illegal money in India is what? Elections. That is liquid. Even that much bad money, black money, worst money, illegal money also will not be staying idle. It will flow. Today it will flow from people to corrupt officer to his top politician. Today, one way direction. Tomorrow the same politician will have all this amassed and the person will spend it again on the people by distributing it to the people to buy the votes. This is a cycle, it goes on, it keeps on going. I'm talking about illegal money. Illegal money though will always be floating, that is liquid. So generally that is what the nature of money is. Money is supposed to be liquid. If it is not liquid, that it stinks. That is dangerous, not good for the economy. It should move on, now or even in future. But people demand for money either for using it now or even in future. For both the purposes, people demand for money. That is why we can call this as a derived demand, not the demand for money itself, but the demand for goods and services to be consumed either now or in future. That is what is basically the concept of demand for money. And although it gives little or no return, by having money with you, what return it will give? Nothing, almost like nothing. Still, individuals, households and firms hold money because it is the most liquid asset and offers the most convenient way to accomplish their day-to-day transactions. That is why people keep money with them, because it is the most convenient way and it is the most liquid form of all assets. All other assets are not that liquid as money. That is the reason, in spite of having no return or having very little return, still people would like to have money with them in order to accomplish their day-to-day transactions. That is why demand for money will be first of all arising, not for money itself, but that is a derived demand. Now, what factors might influence the demand for money? So, how many factors might influence? Of course, income is one of the factors. How can we say that? Because higher the income, higher the demand for money. Naturally, because when income is higher, people will spend more. When they want to spend more, they need more money. So, higher the incomes, higher the demand for money. General level of prices is one more point. Though not exactly same, but more or less, we can say it is like inflation or price levels, let us say. if prices are high, when prices are high, you need more money, no? Less money will give you less goods. You need more money when the prices are high. So when the general level of prices is high, demand for money will be also more. So higher the income, higher the demand for money. These are the logics you should remember and understand and apply. As examples, you should write these things because these are useful in understanding all the other theories of demand for money also. Logical things are very important to be noted. These are logical. Higher the income, higher the demand for money. Higher the prices, higher the demand for money, naturally. Rate of interest. This is a very crucial point also. Higher the interest rate, lower the demand for money. Sir, why is that? Higher the rate of interest, why the demand for money is lower? If the interest is high, what you would like to do? You will keep money with you, or will you purchase bonds, or you keep that money in fixed deposits like that? Definitely you go for something which gives you return, because money does not give any return by itself. You will buy something like other financial instruments which will give you some return in the form of higher rate of interest. For convenience purposes, because we are looking at American type of economics, we have to keep this in mind, though it is not so practical in India that, oh, I have 2,000 rupees, I'll buy a bond today. Like that in India, nobody does. But for understanding purposes, we have to understand that, we have to just assume that people have two types of possibilities or options. Either they can buy bonds, or they can keep money in the form of cash with them in their pockets or in their cupboards. If the interest rates are high, what people will or might likely to do? They go for bonds. They will keep less cash with them and they buy bonds when the interest rates are high. That is why when the rates of interest are high, demand for money will be low. That is the inverse relationship between rate of interest and demand for money. Conceptually, if you understand, same thing will be told by famous economists later. But these are the concepts. If you understand properly, this entire chapter is more or less going towards the same logic. So higher the income, higher the demand for money. Higher the prices, higher the demand for money. Higher the rate of interest, lower the demand for money. And degree of financial innovation. This is a practical thing that we can see. Higher the financial innovation, lower the demand for money. Naturally, now the financial innovation is higher or lower compared to earlier in India? Definitely higher. We have Paytm, we have Phone Pay. Oh, so many payment apps are there. Google Pay, that Pay, this Pay, Razor Pay, whatnot. Too much of financial innovation, convenience of payment, online transfers, all these things are there. When the financial innovation is higher, demand for money will be lower. Naturally. Because you don't need to hold cash or currency in the form of money if you have the financial innovation in a little higher level. Okay, let us forget about all these online things. Let us talk cash only. Let us talk cash. ATMs. ATM is not anytime money. It is automated teller machine. Some people call it anytime money and all. That is very colloquial. The technical word or name of ATM is automated teller machine. Just let us take an example. Let us say if there are more ATMs, what will be the demand for money? Will it be higher or lower? It will be lower. Why? Because people are confident that anytime they can just like that go to an ATM and withdraw money conveniently. So they don't have to hold too much of cash with them. Let it be there in the bank, no problem. That's what they think. So higher the number of ATMs, lower will be the demand for money. More the cash is in circulation, less the demand for money. This is one more place where, unfortunately, of course, after demonetization, once again, our central government has miscalculated this core concept and in fact applied it reverse way. What they did, they made money availability, currency availability scarce, thinking that they will reduce the usage of money because they want the online transactions to be more, they want people to become more electronically savvy, tech savvy, and digital transactions, cashless economy, blah blah blah. All these things were thought. In doing so, what they thought, they reduced the availability of currency. That is absolutely the rubbish thing, because when the currency availability is reduced, people are not going to be shifting to the electronic modes automatically or forcefully like that. what they will do is they will hold more currency now. Unfortunately, that is not the objective. Objective was to reduce the use of cash. Actually, what happens? People will hold more cash now, which is not good. Idle cash is not good for economy, and that's what happens. And that will slow down the economic process. That is one of the reasons why growth rates are down later and post demonetization. When people are holding too much cash with them, not much into the financial system. Why they are holding too much cash? Because they are not sure whether tomorrow ATMs will work or not, whether there will be sufficient cash or not. Some bank might bankrupt. Some of the banks in between have stopped payments, like Punjab, Maharashtra Bank, something like that, PMC Bank, what they call, or S Bank story we heard. IDBI Bank had some problems. So when people lose the trust in the financial system, when they don't think that their money is safe with the banks, or when they don't have the confidence that they can withdraw the money anytime they want, almost literally, if they don't have that confidence, what they will simply do is they'll keep the money idle with them as cash, which is not good for the economy. Ideally, it should be in the financial system circulating. Money should be liquid, it should not be just idle. But with the lesser currency circulation, demand for money becomes more, sir. It is not going to become lesser. I don't know what made the people at top positions think that they will reduce the currency circulation and then reduce the demand for cash, reduce the cash usage and increase the digital payments, online payments and all. No, that will not happen. Actually, the reverse will happen. Less the ATMs, more demand for cash. More the ATMs, less demand for cash. We don't want people to use cash, so we are reducing ATMs. Somebody will say that is foolish, because you are actually doing the reverse thing. You have to increase ATMs. In fact, it is a different story. India has the lowest number of ATMs per 1,000 people in the entire world, at least the developed world. We cannot compare ourselves with Zimbabwe, Ghana, Uganda and all that. But at least in the reasonably known countries, all countries have more ATMs than India per 1,000 persons. What does it mean? What it will lead to? Definitely it leads to more demand for cash, because when people don't have the access to cash quickly, easily, naturally they will tend to hold it, and the demand for money will become more, not less. That is the reality, and that is a very commonsensical thing, not something very technically high level also. Simple logical point. So that is why when the financial innovation is higher, demand for money will be lower. Of course, the good news is post 2016-17, slowly, when the circulation also increased, when we said we are remonetizing the economy and lot of money circulation happened actually. In fact, the total money in circulation is more now in 2020 than it was prior to 2016 demonetization. That means what? More money in circulation is there now, cash. It is there in circulation more than earlier in value, not in number of notes, because number of notes have changed now. Earlier it was 1,000 rupees biggest denomination, now it is 2,000 rupees. But still, in value, the more amount of money is in circulation now in 2020 than 4 years before, which is good. That is not wrong. Some people will tell that, oh, this is also a failure of demonetization. No. That is a good thing. More money in circulation is not bad in that sense. It may be wrong in different ways, but not in the sense of circulation or availability of money should be lesser. No, that is wrong. Availability of money should be higher. At least it should be there in the market flowing. Then people will actually ask less for that money. Now you see, almost during normal days also, people have started using the digital payments more than before. Why? Because now they are confident. Even if they want to really have some cash also, they are confident that, okay boss, I can go to any ATM and get cash. Now there is no scarcity of money much, or cash or currency much, as it was in 2016-17, because of which now slowly the confidence of the people is more. Demand for money will become less. Now cashless transactions will become more. They are becoming more slowly. That is the objective originally. But only point was, it was done in a wrong way earlier. Now it is corrected. Of course, with the interference of RBI also, more money available will reduce the demand for money actually in reality. That is one part of it. Supply part we will see later. But simply in this particular factors that will influence the demand for money, financial innovation is definitely one of the things. More convenient the financial innovation models or online payments are there, secure if they are, if people have more trust on them, demand for money will become lower and lower naturally. So that is the other very important factor. Practically we can see in India, because it is happening in front of us, where we never had any kind of this convenient payment methods earlier. Now we have many convenient payment methods. So financial innovation has increased well, that automatically reduces the demand for money. So that is one more factor. So these are the four factors that will influence. You have to remember and understand not only the name of these factors but also the logic behind them. How that will influence also you should know. Higher the income, higher the demand for money. Higher the prices, higher the demand for money. Higher the interest rate, lower the demand for money. And higher the degree of innovation, lower the demand for money. These are the four factors majorly influence that will influence the demand for money. Of course, the same things we will discuss as theories proposed by some economists later, but the essence of all of them ultimately will be these things only. These are the factors that influence the demand for money. Now let us enter into the theories of demand for money. There are many theories, as I told already. Some of them are called, one of the theories is a classical theory, second one is a neoclassical theory, then we have the famous Keynes LPT, that is liquidity preference theory, and there are post-Keynesian theories also. These are the theories that we should know, and questions can be asked from any of these theories. So we should understand the key features and what are the things that each of these theories was telling us. These are the theories. Let us start with the first one, which is QTM. It is called quantity theory of money. QTM or quantity theory of money, also called classical theory. So in this quantity theory of money, it was one of the oldest theories in the economics, first propounded by Mr. Irving Fisher. So Fisher is a very popular name, even in index numbers and all, Fisher index we call it. So he is a popular economist and statistician, particularly in the aspects of inflation. We will see the Fisher's contribution later also. So he has proposed this quantity theory of money. What this QTM says? QTM demonstrates that there is a strong relationship between money and price level, and the quantity of money is the main determinant of the price level or the value of money. So money is related to price levels is what QTM says. So each of the scientists and economists will focus on one of them only or a couple of them only, not all the factors of demand for money. So which factor? QTM focuses on price level. And what does it mean? It means that changes in the general level of commodity prices or changes in the value or purchasing power of money are determined first and then and foremost by changes in the quantity of money in circulation. In other words, the quantity of money in circulation is going to have an influence on the price levels, commodity prices, price levels or value you can call it, or purchasing power of money. For example, 100 rupees you have, if you can purchase 2 kgs of rice with that, that means each kg was 50 rupees. That is the price level we are looking at. What happens if each kg becomes 100 rupees? Then what happens? Then with the same 100 rupees, you can only purchase 1 kg, not 2 kgs. That means what? The purchasing power of money has reduced. Earlier it used to give you 2 kilos, now it is giving you only 1 kilo of rice. The purchasing power or value of the money has reduced, and how is it determined? According to the price levels of the goods or services. Is it not true? Yes, absolutely. Fisher is right. But he was only focusing on one factor, that is price levels. So what the formula Fisher proposed is MV is equal to PT. Let us have an expansion of what is this. MV is equal to PT. M is the total amount of money in circulation on an average in an economy. That is M, money in circulation we can call it. V is the transactions velocity of circulation. In other words, average number of times across all transactions a unit of money, for example, say rupees is spent in purchasing the goods and services. So velocity means you can say how many times the same money is rotating. That's what people call rotation. How many times it is going to be in circulation for a particular period of time. That is called V. M into V. M is the amount of money, V is the transaction velocity of circulation. That is equal to P into T. P means what? That is the average price level. How to get P? Is MV by T naturally. If you get the other side, MV divided by T is P. That is the price level, we can call it. T is what? The total number of transactions. Total number of transactions is that. Now just take a simple example. Taking, let us say, in a year, a family requires, say, 100 kgs of rice. Right? And each kg of rice, according to our same example earlier, is 50 rupees originally. Okay? That is a price level, let us say, 50. And number of transactions or whatever the quantity we can say, that is what, let us say, each time they will purchase 1 kg only, like that. So how many transactions it will be? 100 transactions it will be. That is what is the money required now for this particular family in that year. That is what 5,000 rupees is the money that is demanded. P into T, price level into number of transactions. That is the demand for money. So here also transaction velocity and amount of money in circulation in an economy multiplied gives us same as average price level into total number of transactions. That's what classical theory or quantity theory of money will tell us. That is the demand for money for a particular family in a year. Like that, if you aggregate it for the entire country, that will be the total demand of money in that year. So MV is equal to PT is the equation according to classical theory or quantity theory of money. But is it the same thing always? No. Actually, here MV only were representing real cash, actually cash money. No. Is it the only money? No, not necessarily. So what later on Fisher has extended this equation to include M dash V dash, that we can call it as credit money. That also is there, right, in the money circulation. So cash money, which is MV, plus credit money, that is M dash V dash, which is nothing but M dash is bank deposits and velocity of those things multiplied will give total value of money that is in demand. So MV plus M dash V dash is equal to PT. That is the demand for money according to Fisher. Later, which has added, which he has added with credit money also. So what is M dash here? Total number of to total quantity of credit money. What is V dash is velocity of circulation of credit money. So these are the things that Fisher has told. Original equation was MV is equal to PT, whereas after that it has been extended as MV plus M dash V dash is equal to PT. That is quantity theory of money. Actually, is quantity theory of money talking about demand for money? Is it? Actually, there is nothing that exactly the demand for money is not having any equation there. He is only telling that money in circulation, whether it is cash money or credit money, multiplied with the velocity of that money is equal to the price levels multiplied with the number of transactions. But where is demand for money in that? Not really. There is a specific mention about the demand for money according to Fisher, but it is embedded in this theory. It is embedded, inbuilt in this theory as dependent on the total value of the transactions undertaken in the economy. That is PT, na? Total value of the transactions undertaken in the economy is what? That is the price level multiplied with the number of transactions. That is where the demand for money itself is also included. So it is not really talking about demand for money. It is talking about the total value of transactions undertaken in the economy in a particular time period. So there is an aggregate demand for money for transactions purposes, and more the number of transactions the people will want, greater will be the demand for money. So what is the major purpose of demand for money according to Fisher classical theory is transaction purposes. How do we prove that? That is where PT is telling us the total volume of transactions multiplied by the price level, PT, represents the demand for money. So it is not actually telling about demand for money especially, it is only talking about the value of money that is required in order to undertake some transactions in a particular country in a particular time period. Naturally, if the people want to do more transactions, then their need for money or demand for money also will become higher and higher. So demand for money as far as classical theory is concerned simply can be calculated by multiplying the total volume of transactions in the form of T, number of transactions, multiplied with price levels P. That PT represents the demand for money according to classical theory. Now, moving on to the second kind of theory, that is neoclassical theory. Neo is like new. Little bit of extension or little bit new things added to the classical theory. So this is also called Cambridge approach. If the question asks what is the Cambridge theory of money, you should write this only. That is neoclassical theory. It was put forward by many people, not put together at the same time, but all of them almost supported it. So Alfred Marshall, most famous economist, no doubt. Pigou is another famous economist. Robertson, not that much. Keynes we know already. So these people were associated with Cambridge. Keynes was also associated with Cambridge, means Cambridge University that time in UK. So there they have proposed this theory. So it is also called Cambridge approach. We don't need all this history and geography. Main thing is, what does this theory say? What is this neoclassical theory talking about? What classical theory talked about? Mainly money is demanded for transactions purpose. That was the conclusion of classical theory. What is neoclassical theory is telling? It is adding something else. One more thing is added. So this version holds that money increases the utility in the following two ways. One, enabling the possibility of split up of sale and purchase to two different points of time rather than being simultaneous. So transactions okay, but transaction of sale and purchase need not happen at the same time, isn't it? With the use of money, these two things can happen at different times also. So there can be a deferred payment. Payment could be deferred. Receipt can be deferred. So that way money helps or creates a utility to split the transaction of sale and purchase into two different points of time rather than being simultaneous always, not necessarily. Now that we have money, money acts like that, creating a utility by creating a possibility of splitting up of the sale and purchase transactions into two different points of time, not necessarily being simultaneous. That is one point. Money actually serves the purpose as, and also it acts like a hedge against uncertainty. So uncertainty is something about future where people don't know about future much. So naturally when the people are more uncertain about the future, they demand more money because they feel safe when they have more money with them, because they think that it will hedge the risk or uncertainty. Hedge means it is like a shield for something bad in future. So a lot of times people and families save money for unforeseen expenses that might be there in future. That is one more purpose why people will hold the money. One thing, they will hold the money because it creates a possibility of split up of sale and purchase to two different points of time. Second, since money acts like a hedge against uncertainty also, there will be demand for money according to neoclassical approach. So what does this approach actually say? Though it says the money has two utilities, what is the final conclusion or core proposition of this neoclassical theory? So what this theory says is the demand for money partly depends upon the income and partly on the other factors, of which important ones are wealth and interest rates. So are these not the same factors we looked at originally? What factors influence the demand for money? Yes. But only point is, some approach will focus on one type of factor, few types of factors. Another approach will focus on some other types of factors. What factors neoclassical approach is focusing much on is, one is income, definitely yes. And other factors like wealth and interest rates also matter, and they will also act as determinants of demand for money. For example, here the former determinant of demand, when you look at in these two things, which is income, points to the transactions demand such that higher the income, greater the quantity of purchases, and as a consequence, greater will be the need for money. This is what we already discussed earlier. When the income is higher, when people will have more transactions done, because they have more income with them, they would like to spend more, and when they want to spend more, they will enter into more transactions. When they want to do more transactions, they need more money. So naturally, incomes being higher will result in greater need or demand for money. That is first part. And not only that, because of this theory says the demand for money also involves a precautionary motive. So one way we can say this goes into two aspects. One is a transactional motive, second one is precautionary motive. So what is the speciality in this neoclassical theory? Earlier, in the classical approach, Fisher only focused on transaction motive. Majorly, only transactions were focused, not other things. But now, one thing else also is added in the neoclassical theory. Of course, money is held for a transactional motive, that too not just current transactions, even transactions which are deferred. Payments could be deferred related to those transactions. So that is one thing that money does, and more the income, more the transactions, more the demand for money. That is one angle of demand for money. But not only that, because money acts like a hedge against the uncertainties in future, that is held for precautionary purposes also, according to Cambridge approach or neoclassical theory. Now, what is the equation that neoclassical theory proposes? MD is the demand for money. At least it is giving a direct formula for it. Earlier classical theory never said any formula for demand for money. It said M into V is equal to P into T. Okay, of course it will be equal. But PT is the demand for money according to that theory. But here, what is the demand for money, MD? We can understand whatever is the what are the factors right side of this equation. Those are the things which will influence the demand for money naturally. Y is one of the factors, that is the real income, national income. P is what? The average price levels of the currently produced goods and services. For general understanding, you can say inflation, only for understanding. So price levels multiplied with income will give us nominal income, because real and nominal difference we should know. Real is something which is not having an effect of inflation. Nominal is something which is inclusive of inflation. So Y, if it is real income, multiply that with P, gives us nominal income. So PY is nominal income. But main point is K, which is the actual secret suspense. What is that K? That is the proportion of PY which people want to hold as cash. That is what is K. If we know that, that is the demand for money, but we don't know that. Nobody knows that. That only can be seen on the actual basis. So that K is also called as sometimes Cambridge K. So that can be a point or question itself. What is Cambridge K? K is that proportion of the nominal income of a country in which the people would like to hold as cash. Let us say if K is 20% or 0.2, then whatever the income, nominal income of a particular country is, just for understanding purposes, let us say if nominal income of a particular country is 100, if 0.2 is the K, that means demand for money will be 20, whatever those numbers mean. So that is K. It is the proportion, 20% of the overall nominal income of the country people would like to hold in cash. How much is that K? That will be different from country to country. That will be a reality. That is called Cambridge K. And that much percentage or proportion of the nominal income people would like to keep in cash, that naturally will be leading to the demand for money, which is MD. So what we can say here, what are the two factors that are influencing majorly? One is income of the people put together, that is what is national income. And second thing is inflation levels or price levels, definitely. And third thing is how much percentage people would really like to hold in cash. And that will change. Imagine so many factors will have influence on them. If people are more secure about their future, then they would like to have less holding in cash. They don't need to worry about too much of future uncertainties. But if they are more uncertain about the future, then they would like to hold more cash. So it depends upon the psychology of the people also. The word used here is K is the proportion of nominal income that people want to hold. Want means itself, that's a psychological thing. That will be depend upon many factors in reality. That's what neoclassical approach says. MD is equal to K into PY. K is also called as Cambridge K. P is price levels, Y is real national income. So after the classical approach and neoclassical approach, let us move on to very important and more popular liquidity preference theory proposed by famous economist Keynes. And Keynes theory of demand for money is also called as LPT, that is liquidity preference theory, a very popular theory. So what Keynes says according to this theory is that people hold money or in cash for three motives. Three motives. One is a transactions motive, we know that. Second one is precautionary motive, we know that. Now he added one more, speculative motive also. So if you observe, actually in the classical, Fisher only told about transactions, focused on that more. In the neoclassical, all these people, neoclassical economists, what they focused on? Transaction plus precautionary. Now, Keynes liquidity preference theory, he added one more. Transaction motive also is there, precautionary motive also is there. One more thing what he added is speculative motive also is there. So these are the three motives for which people will hold cash according to Keynes liquidity preference theory. Let us look at these motives one by one. Most of them are generally understandable. The first two at least are repetitions of what we already know. What is transaction motive? Simply that is the motive of the people to hold the cash because they need cash for current transactions, for personal and business exchange. If they want to purchase something, goods or services, they need money. So in order to enter into such transactions, they need money. So that motive with which that cash is held is called as transactions motive. And the need for holding money arises because there is a lack of synchronization between receipts and expenditures. That is an important point also. Imagine there is a businessman. Daily he will have some receipts and daily he will have some expenses also, let us say. Will they be same always? Not necessarily always same. Imagine if the expenses are more than the receipts on any one day, he will not be able to spend that, which means he is failing in his duties. Such situation he doesn't want to have. There will be a mismatch, no synchronization, lack of synchronization. There is going to be a mismatch between receipts and expenditure. And how to bridge this gap? Money will bridge this gap because you have sufficient money with you, cash with you, liquidity with you. Then such mismatch between receipts and expenditures can be somehow bridged. That is also transactions motive, basically, for which people in the sense, not only individuals and households, even businesses hold the money for this purpose of transactions. And naturally the transactions demand for money is related to the level of income. So as far as LR here is only this transactional demand for money. So transactional demand for money, if you call it LR, that is equal to K, which is the ratio of earnings which is kept for transaction purposes, and Y is the earnings. So if somebody is having an income of Y, as a percentage of that, some proportion of that will be held in cash for transactional purposes. That is what is transactions motive, we can say, as part of liquidity preference theory of Keynes. So points to be noted here are, once again, definitely money is needed for entering into the current transactions, whether for personal purposes or business exchanges. And why this need for holding of money arises? Because of the lack of synchronization between the receipts and expenses. And how the transactional requirement of money will be, or demand for money will be determined, it is directly related to the level of income. If the level of income is more, transactional requirement of money also will be more. But how much money will be required as a proportion of the income? That is K. Same K as we already know in the neoclassical approach. But this percentage is different. We are not talking about only the entire thing, only looking at here the earnings. So why if it is the earnings? K is the percentage of the earnings which is required for current transactions and which is kept for transactional purposes. That is transactions motive in a nutshell. Then, what is precautionary motive? Again, understandable, but mostly psychological thing. This is precautionary motive is mostly psychological. Many unforeseen and unpredictable contingencies involving the money payments occur in our day-to-day life, naturally, yes. And that is why individuals and businesses keep a portion of their income to finance such unanticipated expenses. If they come in future, suddenly if we don't have cash, that will be a problem. That is why we keep it as balance with us, so that if such unanticipated expenditures really become true, really if they are coming and facing us, we will be able to finance such unanticipated expenditures with the cash balances that we have. For that purpose also, people will hold cash, people will hold money. For which purpose? With what motive? That is precautionary motive. Now, how much money will be held for precautionary motive? That is something which is difficult to predict, because once again it depends upon intentions of the people. Various factors will determine how much money will be actually demanded under the precautionary motive. It depends upon the size of income. Once again, more income, more precautious, more demand for money naturally. And not only that, the prevailing economic and political conditions, if they are very good, people will not have so much of fear about the future. If the political and economic conditions are positive, fantastic, going well, why would people need money now for future? Because they are okay with this existing good situation. But if the situation is not good, they anticipate something wrong might happen in future. And that is why they hold more money in cash to meet those unanticipated future events which might be negative to them. According to them, it is again their perception, not reality. It's about the perception that people have. If people are confident about future, they don't hold too much money now. If they are not confident about the future, or if the existing political economic conditions are very volatile, then people will definitely would like to have more cash and money available with them. That is the basic psychology of the people. And of course, that depends upon the personal characteristics of the people also, like optimism and pessimism. An optimistic person who thinks that in future everything will be fantastic, he does not need to hold too much money for precautionary purposes, because he is not very precautionary. He is looking at future in a very positive sense. Why should you take too much precautions? Not necessary. But there will be pessimistic people also. And sometimes if it goes to a next level, there will be cynical people also who think that only worst will come in future. So they will be more precautious, they will be more conservative naturally. And what they will do? They will hold more and more and money. So it depends upon overall characteristics of the people, also existing economic and political conditions also, size of the income also. All these factors will influence on the amount of money that is demanded for precautionary purposes. And as far as Keynes is concerned, he regarded these precautionary balances just as balances under the transaction motive as income elastic. So transaction motive is income elastic or not? When the change in income happens, money required for transaction motives will be changing along with that or not? Yes, that was given already. Same like that, Keynes said precautionary motive also is a demand is going to be definitely influenced by size of income. Same, it is also income elastic, and by itself not very sensitive to the rate of interest. So right now, for both these things, whether it is transactions purpose or precautionary purpose, is there any link between demand for money and interest rates? No, there is no link. Link is where only with Y, that is income of the people. So more the income, more money will be kept for transactional purposes, more money will also be kept for precautionary purposes, though precautionary motive will have a lot of psychological factors also in play, but never both of them will have much of influence from rate of interest. So both these things are not sensitive to rate of interest. Now the third thing comes, which is sensitive to the rate of interest. This is where the interest rate will come into picture. Then this is a new thing. Actually the other two things already classical approach, neoclassical approach told, nothing new there. Classical approach also told transactional purposes people hold money. Neoclassical approach told transactions also, precautionary also, people hold money. So what is a new addition by Keynes in this liquidity preference theory actually, which makes it more interesting and more important also, is a speculative motive. What is this speculative motive? Speculative in the sense not that people are gambling type or they want to speculate too much on shares and all, not in that sense. It is about people want returns. They just don't want their money to be idle. That is naturally one of the aspects of people. Once again, we have to keep America or such kind of countries and economies in mind when we read and understand such theories. They may not be 100% suitable for Indian context and Indian psychology. That's a different story. So these theories are not made for India, by India also, not made for India also, not made in India also. So that is why we cannot restrict it to India always. Wherever it is possible, we do that for application purposes. But these theories are applicable for advanced countries, more market economies, where advanced financial markets, capital markets exist. So keeping that in mind, will people have speculative motive? Yes, in those countries, in those places, speculative motive also will be there, which reflects the people's desire to hold cash in order to be equipped to exploit any attractive investment opportunity requiring cash expenditure. So now they will hold cash. Now they will hold cash. Why? Not for transaction purposes, not for precautionary purposes. That anyway they will hold. And this is not something only for which people hold. People will anyway hold for transaction purposes some money. Plus they will hold some money for precautionary purposes. Plus yes, some money they will hold for speculative purposes also, wherein this portion they can use for investment opportunity if it comes in future. So suddenly if there is a good investment opportunity in future, if we don't have cash, we will lose that opportunity. So what we will do? In order to be equipping ourselves to grab that opportunity in future, we hold money now. That is what is speculative motive according to Keynes. And the speculative demand for money and interest are inversely related. Very important point. In other words, when the interest rates are high, the speculative demand for money will be low. Simple logic you can understand. When the interest rates are high, what is better, to keep in cash now or to keep it in bonds where the interest rates are high? Naturally, it is better to keep in bonds. So what happens? Demand for money will become less, demand for bonds will become more. And vice versa happens if the interest rates are low. If the interest rates are low, what might happen is, in future, they may rise. If the interest rates are already low, in future, they may rise. When the interest rates rise in future, bond values may fall. Why? Because the market value of the bonds and interest rates are also inversely related. So when the interest rates are high, market value of the bonds will be low. When the interest rates are low, market value of the bonds will be high. So if the interest rates are low, now the bonds are overvalued, let us say. We don't want to buy bonds. We want to keep that in cash. Why should we buy bonds now when they are overvalued? We wait. When the interest rates later become high, then we will buy those bonds with that cash. So simply speaking, market values of the bonds and interest rates are inversely related, because of which the speculative demand for money and interest rates are also inversely related. These are the 2 points, core things that we should understand when we look at demand for money for speculative purposes as per Keynes' liquidity preference theory. So what is the conclusion we can draw from this is, particularly speculative motive? So long as the current rate of interest is higher than the critical rate of interest. So Keynes said people will have something in their mind called RC, critical rate of interest. You can call it normal rate of interest, which is expected by the people normally. If the current rate of interest is higher, so what we should do? A typical wealth holder, what he will do? He will not have cash because interest rates are high now. He will go and buy only government bonds. So he will buy the bonds than keeping that money in cash. And on the other side, if the current rate of interest is lower than the critical rate of interest, then his asset portfolio would consist wholly of cash. So it is it's like a all or none type of game that Keynes has suggested. Of course, not the entire cash is held for speculative purposes. We have to understand this is in addition to the cash that is being held for transactional and precautionary purposes. For speculative purposes, if at all cash is held Why is it held? With an anticipation that in future the bond prices will become lower. Then we can capture that opportunity and buy them. How the bond prices will become lower in future? If the interest rates become higher in future. How the interest rates will become higher in future? Naturally, when the interest rates are now lower. So if the interest rates are now lower, we'll keep cash. If the interest rates are now higher, we'll completely keep the entire money in the form of bonds. That's what is speculative motive as per Keynes' theory of liquidity preference. So here it is understandable with the graph also. If this is the general expected normal rate of interest, we can say, and if the actual interest rate in the market is high, then the entire amount, so look at this solid line, entire amount is invested in the form of bonds only when the actual interest rate is higher than the expected or critical rate of interest. If actual market rate is lower than RC, then the entire amount is invested in the form of cash only. It is not going to be going between them. It is not going to be a balanced portfolio according to Keynes. Reality will not be like that. According to this theory, if the actual market rate of interest is higher than critical rate, then entire money is going to be held in the form of government securities or bonds. On the contrary, if the market rates are less than the critical rate, now entire money is kept in cash. Why is that? Because now the rates are low, in future they may become high. When they become high, in future the bond values may fall down. That may present a good investment opportunity to purchase the bonds at lower value in future. But in order to grab that opportunity in future, now we should have money. That is why we hold complete money in the form of cash now, in anticipation of the increase in interest rates and decrease in the bond values of future. That is the speculative demand for money according to Keynes. After these three theories of classical approach, neoclassical and Keynes theories, let us move on to post-Keynesian theories. Post-Keynesian theories means after Keynes somebody else has proposed different approaches also. One of those approaches is called inventory approach. One of that approaches is risk approach, and another economist called Friedman has also proposed a theory. These three are part of post-Keynesian theories, we can say. Let us study each of them one by one. First thing first, inventory approach is not new to us. If you remember in the financial management, working capital management, William Baumel's model, as we see that, just like we calculate economic order quantity for materials, we can calculate optimum cash balance also according to William Baumel's model. So in other words, what Baumel has considered money as if it is inventory. So it is an inventory approach. Baumel and another person, Tobin, also developed this theory, that is deterministic theory of transaction demand for money, known as inventory theoretic approach, in which money or real cash balance was essentially viewed as inventory held for transaction purposes. How much money should be held depends upon many factors. Of course, what are the factors are also told by Baumel. But why people hold money, real cash balance, that they will treat it as inventory according to Baumel and Tobin for transaction purposes. So how much money they will hold? People will hold optimum combination of bonds and cash balance. So this is actually not in line with the Keynes theory. What Keynes said in liquidity preference theory, either people will hold bonds completely or people will hold cash completely. That's what he said, which is practically not possible. So what this approach says, people will shift between these two things. They will have an optimum combination of these two, both bonds and cash balance, with such a way, in such a way that it minimizes the opportunity cost. What is the opportunity cost of money? Interest, actually. If you keep money in the form of cash, you are losing the interest on the bonds naturally, isn't it? That is the opportunity cost of keeping the cash, not investing in bonds. So the people will have a balance of cash also. They will not hold 100% bonds or 100% cash. They will have a balance of cash also. They will have a balance of bonds also. In such a way they will balance it so that the opportunity cost is overall minimum. That's what is Baumel's theory or inventory approach, we can say. So how this optimal average money holding is going to be determined? It is a positive function of income Y. So Y is more, income is more, naturally money balance required will be more, and it is a positive function of the price level P, that also we already discussed. If the price levels are more, you need more money, so demand for money will be more, and it is a positive function of transaction costs. When the transaction costs are more, demand for money will be more. Why? Because you cannot do the transactions every time. Same way, simple, just let us say ATM has charges. Every withdrawal, let us say, is chargeable. Then are you going to withdraw from the ATM so frequently, or are you going to withdraw more money at the same time from the ATM to avoid the charges? Ideally the second one, because more the transactions you do, more charges you have to pay. So what you will try to do ideally is you will try to do less number of transactions. That is another problem, where some of the banks are charging high after certain number of transactions in a month. 4 transactions are only free, after that we will charge you, like that some banks are telling. It is dangerous for them only. Why? Because when there are less number of transactions which are free, what people will do, because of their intention to avoid the charges, they will hold more money. So when the transaction costs are more, demand for money will also be more. Then instead of doing more number of transactions, they try to keep more money or withdraw more money in less number of transactions. So demand for money definitely, or average optimal balance of money, is a positive function of transaction costs also, and it is a negative function of the nominal interest rate I, and this we already have seen as well. Interest rate and demand for money are inversely related. Why is that? Why that I is inversely related to the demand for money? Because that I is the opportunity cost. If the I is high, that means the opportunity cost of keeping the money in the cash form is high. So what happens? Rather than keeping it, it will be converted into bonds. So higher the interest, lower the demand for money, because interest is representing the opportunity cost of keeping the money in cash balance. So these are the points here. Once again, same things that we have almost discussed in the original theory, before even starting the theories. Basic influencers of demand of money are these only. But one thing extra that Baumol and Tobin have added here is transaction costs, which is definitely an important point, important addition in this inventory approach. So what are the final factors which will influence money demand according to the Baumol and Tobin? 1, income, which is a positive function, means directly related. Income and demand for money are directly related. Price levels and demand for money are directly related. Transaction costs and demand for money are directly related. Interest rate and demand for money are inversely related. Positive function means directly related. Negative function means inversely related. That's what inventory approach told us about demand for money. Now, what about Friedman's theory? So here basically there is no much of addition here. It is only just a extension of the Keynes theory, which talked about the speculative money demand within the framework of the asset price theory, which holds that demand for money is affected by same factors as the demand for any other asset. What are those factors? Namely, permanent income and relative return on the assets. So what any asset. So what basically Friedman said is, first, why are we talking about money and all? Money is also just one of the other assets. All assets are part of the wealth of any person. In that, money is one of them. So the demand for money also is influenced by the same factors which will influence the demand for any other asset. What factors will naturally influence any asset is 1, income, that is permanent income, and second is returns on the assets. In other words, we can say, just for understanding purposes, it will give some interest or profit, let us say, just for understanding purposes, not exactly same, and it will also have capital gains. Any asset is held for 2 things. Either it will give some regular income, after some time if you sell it, it might result in some capital gains. Like that only money also will be looked at as per Friedman. But of course, money itself will not give you any return, money itself will not give you any capital gain. Actually it will be loss because of the time value of money. That's a different story. But what Friedman argued is, there is no speciality about money as a separate class of asset. It is a class of asset just like any other asset, demand for money is also determined. So what he said, there are 4 determinants of the demand for money according to Friedman. So Friedman told 2 things, 4 things here. What are the 4 determinants? First thing first, total wealth of the person. He is not talking income here, he is talking wealth. That is one difference he has made here. Other things are same actually. So total wealth of the person includes what? He has identified different types of we can say asset portfolio. 5 types he has identified actually. Money is one, bonds, equity, physical capital and human capital. Physical capital is sometimes called real estate or whatever is tangible available to us in front of us. Mostly real estate. Human capital is people we have. Okay, those are slavery days where human capital is also there. So let us not get into that much, though it is not tangible. But total wealth of any person will have these things: money, bonds, equity, physical capital and human capital. In that some percentage is held as money naturally. More the wealth, more money will be generally required. That's what Friedman said. One of the determinants of demand for money is total wealth. And that is a positive relation. Plus means here a positive relationship. Means what? More the wealth, more demand for money. Second thing, price levels. We know this already. If the price levels are high, more demand for money is there. Third, opportunity cost of the money holding. This is a negative relation because it is interest rate, simply speaking. The returns on the bonds and stock. On the bonds it is interest rates, on the stocks whatever the return the stocks generally give in a open capital market, stock market. So if the returns on the bonds and stocks is high, why should we hold cash unnecessarily? We should not hold. Ideally we should keep in those things. So what happens if the returns are high there in the bonds and stocks, the demand for money will go down. So we can call that as opportunity cost of money holdings, which is nothing but returns on the bonds and stocks also he has added. Earlier stocks was not discussed by many other economists. This guy has added stocks also in that. That is one more point he has added. And he has added this very important point of inflation also. If the inflation is high, definitely the demand for money will be low. Why is that? Inflation is also one of the factors which will have the purchasing power of the persons determined. So the amount that is really required to be held will become lesser and lesser. Let us say, in other words, real anything is nothing but nominal by interest rates. Inflation we can say. Nominal is nothing but inflation into real. So what is the real thing that is required money wise you have to hold? It is inversely related to inflation. If the inflation is high, the real money that you should hold is less, because the nominal money what you are holding is high already. Since the inflation is also high, the real money required is low. So the demand for money will be inversely related to inflation according to Friedman. There is a little you can say conflict between price level P and inflation, because price levels also normally reflect inflation. So we have to just look at Friedman's theory in a different way than the other theories. Why? Because here he has not looked at P as inflation. He has mentioned P separately and inflation separately, whereas the relationship is not the same. If P or price levels are high, more money will be in demand. If inflation is high, less money will be in demand according to Milton Friedman. So here he added 4 determinants of money: wealth, price level, opportunity cost of money holdings and inflation. This is also one of the post-Keynesian theories, whereas Milton Friedman has actually extended the Keynes speculative theory of money or speculative money demand only, but in a different way, taking different classes of assets and thinking that money is also just one of those assets, nothing special about it, as per Milton Friedman. Now there is one more approach which is called risk approach, we can say. Mostly it is proposed by Tobin. Inventory approach also, Tobin was one part of it. Tobin also extended in addition to the inventory approach along with Baumol. Now Tobin's approach is also called risk approach. Here the demand for money is a behavior that is towards aversion to risk. That is propounded by the Tobin. This states that money is a safe asset, but an investor will be willing to exercise a trade-off and sacrifice to some extent the higher return from the bonds for a reduction in risk. So simply speaking, always risk and return are to be balanced. Risk and return have to be balanced. Let us say having more cash with us is less risky. It is the best possible option actually. Why? Because no risk at all. But accordingly, what also happens? Return also will be low. In fact, it will be negative return due to time value of money. But what Tobin argues is people are ready to take some level of risk, not like complete risk, but they are going to sacrifice that safety net and take some risk with an intention of getting some higher return from the bonds so that there can be a little bit of reduction in the risk. So that is where they will be able to trade off between the risk and return according to Tobin. So according to this Tobin, rational behavior induces the individuals to hold an optimally structured wealth portfolio which is comprised of both bonds and money, and the demand for money as a store of wealth depends negatively on the interest rate. As far as the final conclusion is concerned, there is nothing separate or different or new. Same thing we know. Demand for money is negatively related to or inversely related to the interest rate. That is clear. But in what sense he is mentioning this is from a risk point of view. People will have some aversion to risk also, because of which they will keep some money. But how much money, that is not about us to just determine. They will have a balanced portfolio, an optimally structured portfolio the people will create themselves, keeping risk and return also in mind. Naturally, when the interest rates are high, the demand for money will be low. Interest rates are low, demand for money will be high, which already is proposed by many other people, but from a different perspective. As far as Keynes is concerned, he told it from a speculative purpose or speculative motive. As far as Tobin is concerned, he is looking at the same factor, giving the same conclusion, but the approach from which it is looked at is not from a speculative purpose. It is from an aversion to risk point of view, which normally people will have as one of their psychological traits or behavior. That is the Tobin's risk approach. These are the neoclassical theories of demand for money, we can say. Sorry, the post-Keynesian theories of demand for money. We had all list of various theories in this particular unit. One is classical theory, also called QTM. Then we have neoclassical theory, and then we have liquidity preference theory, and then we have post-Keynesian theories. And within post-Keynesian theories, we had inventory approach, and we had risk approach, and we have Milton Friedman's theory also as part of money being one of the assets in a wealth portfolio of any person. These are various theories related to demand for money. With that, we can conclude this unit 1 of chapter 3, and in the next unit of the same chapter we will talk about and discuss about supply of money. So one side of the money we have understood, looked at in this unit. In the next unit we will look at the other side, that is supply of money, how it is important for an economy and how is it measured, particularly in Indian context. Those things we will discuss in the next session, in the next unit. Till then, take care. Bye bye. Thank you very much.